Hello friends, today's topic 1, 3, 7, 10 rule. Follow this new rule in SEP to avoid losses. I am Dr. Bharath. Purpose of the video is service to society. In order to make it easy for us to remember the important things with respect to our SIP, finance experts have created a rule called 7531 rule. Since most of our channel members are investors who do SEP, we have modified the rule to suit your requirements and to follow it accordingly. The rule for SEP is called 1370 rule. The significance of number 1 is as follows. We should remember to step up our SEP once a year as our income increases. It could be an increase of 5 to 10% or whatever percentage is comfortable. This will help you to create a large corpus in the long term. Step up SEP gives an advantage compared to fixed amount of SEP throughout our lives. The 3 in the rule signifies 3 points of confusion in our mind. Number 1, shall I book profits? When we see good profits made on our long-term portfolio, we are usually tempted to sell and then buy back at lower prices. Unfortunately, this decision of profit booking usually backfires on a long-term investor. Second one, shall I stop SEP? During certain periods, markets are very dull or falling. The motivation to regularly do SEP is difficult to maintain. Sometimes for 1 or 2 years, the returns from stocks could be lower than even bank FDs, and it starts creating doubts in the minds of investors of whether to continue investing or not. Third confusion is, shall I sell my shares? Certain times, for various reasons, stock markets crash, such as due to corona, war, economic slowdown, political instability, etc. At such times, it makes investors panic and sell. However, usually the reason for crash is short term and later these shares are likely to recover in the long term. So don't unnecessarily sell shares. So we need to manage 3 aspects of mindset towards investing if we have to become successful in stock market. The 1, 3, 7, 10 rule, the significance of number 7 is followed. In some earlier videos on our channel, we have presented the data on how many years should we do SEP to not face a loss at all. As per statistics of Nifty 50 index, investor should invest for a minimum of 7 years to not experience a loss. The following is a detailed figure. One day, the loss of instances of negative returns are 46%. 1 month, percentage of instance of negative return 39, 3 months 36, 6 months 32%, 1 year 25, 2 years 17, 3 years 8, 4 years 5, 5 years 0.1, 7 years 0, 10 years 0 instances of negative return. So 7 stands for minimum number of years to invest to ensure safety of investment. Also, when we invest for at least 7 years, we are giving a good period of time for our money to multiply and for companies to improve their fundamentals. Here is an announcement. There is a webinar, Learn Stock Markets from Scratch. It is happening on 5th November, 10:30 a.m. to 12:45 p.m. Cost of the webinar is rupees 199 for the first 75 participants. After that, it goes to 499. Dr. Bharath graduates need not attend, and the seats are limited to the first 150 because normally we receive applications in excess of 300 to 400, and first come first serve basis only first 150 will be selected. What will you learn in this webinar? How profitable stock markets are in the long term and short term. Normally, most of the people who are freshers into stock market are not knowing the profitability of the stock market. And then what was the past profit, what can be the expected future profits, etc. So we are giving a perfect picture of the profits of the stock markets. Second is stock market myths. Lot of people feel that stock market is meant for short-term buying and selling. And then the longer you keep, more losses you make, etc., etc. And then many people think IPO is the most profitable way to make money. All these myths will be removed in this webinar. Third one is basic fundamental analysis and basic technical analysis. By doing this, you will invest for 5, 10, 15, 20 years and you will start making more profit than whatever you think was possible, and short term you will be able to amass at least few thousands every month for offsetting your expenditure. Now click on the payment link in the description box below and register. You will get the webinar link within 1 day after payment. Now continuing the topic of the video, there are stocks of around 22 to 24 sectors, the Nifty 50 index. So you can see how diversified it is. However, it is not necessary that we diversify in too many sectors. We should focus on 10 sectors which you feel has the most potential in the future, and accordingly select 1 or 2 companies in each sector to invest on a monthly basis. This way, you will have around 10 to 12 companies in your portfolio for long term spread over 10 sectors. Too few sectors can lead to high risk, and too much diversification results in below average returns. This is the significance of 10 in 1370 rule. Now, summary of 13710 rule. Number 1, step up SEP once a year. 2, manage 3 mental aspects of investing. 7, minimum 7 years of investment. 10, select 10 different sectors for investment. Now at the end of the video, here is a question. According to you, which point is most important in the 13710 rule? Type that particular number in the comment section. If you are not the member of Dr. Bharath Chandra, Rohan Chandra channel, this is the time to subscribe. Press the bell icon. Send the video to all your friends. The video is good. Press the like button. Thank you for watching. Bye bye. All the best.